Hey traders, Jason here from Leavitt Brothers. Happy Monday. Hope you had a good weekend. It's time for an update on my State of the Market series. Most of the indexes continue to press higher. The Dow, the S&P, the Nasdaq, they're all pretty close to their all-time highs. The mid caps are lagging some, but they're making progress. The small caps are lagging a lot more. It's pretty noticeable. They're nowhere near their highs, just like the other indexes. Okay, I'll show you the chart in a minute. The goal here is to look under the hood and see if there are any warnings. How are the AD lines doing? How are new highs doing? Does the market's breadth support a continuation of the trend, or are there subtle hints weakness is brewing? Let's see what's going on beneath the surface. The main indicators I look at are various versions of the advanced decline line. Okay, so different versions, different time frames. New highs and new lows, again, on different time frames, and the number of stocks above certain moving averages. Okay, the goal is to essentially see what the participation rate is. Okay, if the market's moving up but the AD line is moving down, that tells you that there are a smaller number of stocks pulling the market higher while a lot of stocks are declining. If the market's moving up but new highs are lagging some, maybe new lows are ticking up, it'd be a little bit of a warning. If the market's moving up but the number of stocks above their 20-day moving average, their 50-day moving average is starting to decline, then again, you know that there's a smaller number of stocks pulling the market up while stocks one by one are falling off. So these are the main things I'm going to look at here. All right, so let's get to it. All right, so here's the S&P 500 daily. You can see we had a big move down, big move down, big recovery. And now we're back at the highs. Okay, so we have the index is trending up. It's above its 200. It's above its 50. It's pretty much above every single moving average that you could put on this chart. It's close to its all-time high. You could argue that, short term, you could argue, hey, it's done really well. It's gone from like 2350 up to 2900. The trend is up. Everything's doing great. If you back up a little bit, you can draw, a box around the price action, something like this. Ignore the late December, early January action, and you can say, hey, even though the near term looks good overall, going back like 18 months, the index has actually just been range bound. We've gone up, we've gone down, we've had some big moves in both directions, and we probably shouldn't get overly excited about what's going on because really nothing has gone on over the last year. And that's a legit argument. Okay, maybe we press higher to a new high here. Maybe we just kind of roll over and fall back into the, to the middle of the range. I don't know. Near term, things look good, but overall, let's not get too excited because the reality is over the last year and a half, the market really hasn't done much of anything. Here is the Russell 2000 small caps. Different story, obviously. So if I draw another box here, you can see most of the action has taken place within that. So, going back 18 months, the market is, the small caps are pretty much unchanged. We have a big void space here, okay, where the S&P and most of the other indexes are near their high. The small caps are nowhere near. We're getting a divergence in the near term. In fact, right now, the Russell is below its 200, and it's, depending on today's close, it could be below its 50. So at best, this is neutral. Okay, it's just trading in a range, up, down. Right now, it's probably in the bottom half of its range. Nothing to get too excited about. Okay, the small caps don't need to lead. Some people think that it's like an indication of people, traders and investors' willingness to take on risk. I don't buy that. The small caps don't need to lead, but they can't lag by too much. You can't have most of the indexes making new highs, and the small caps are not even close. Okay. Small caps don't need to lead, but they do need to participate to some degree, and right now they're not participating. So it is a little bit of a warning. All right, let's check out the breadth indicators. Here is the S&P 500 down up top, and we have the 10-day moving average of the AD line in the middle, and then the AD line down below. When the market is healthy, you get oscillations from the 10-day just in a range, okay? Mostly above zero, some dips below zero, no big deal. That is how the indicator acts when the market's in good shape. Okay, so if I look over here, I'd say, we're pretty much doing that. Okay, right now we're on a move down, but that's no different than this move down and this move down and this move down. okay, which just coincided with, you know, little pause there, dip there, and such. Okay, so the fact that it's down here at 0 isn't a concern to me. I know we have a divergence because the index is pressed up and the indicator's going down, but I would consider this to be perfectly normal action. Okay, the market expands, then it rests, and expands, and then it rests, and you know, I don't think it's a big deal. Now, if we start getting prints down here, that's a different story. If it starts to move up and fails to reclaim 0, that's a different story. But right now, I would consider this to be like a normal dip within a healthy market. And looking at the 80 line down below, it's trending up above its 50-day moving average. Higher highs, higher lows, all that jazz is in place. So until this, you know, rolls over and then, you know, the 50 kind of goes like this until we get rejected here, I'm not too concerned. So in the near term, you could say this is more neutral because this is rotating down, but overall, I'd say the market's in good shape. All right, here's the exact same chart with the Nasdaq. I'm not going to go into it too much because this situation is identical. Okay, we have the indicators rolling up and down. Right now, we have a move down. Not a big deal. The cumulative version of the line is, you know, trending up overall, and it's above its 50. So not concerned. I would get concerned if this moved down and then got rejected by its moving average and then put in a lower low. That would be a concern, but it hasn't happened yet, so I'm not going to get too worried. Zooming in a little bit, the 80 line of the large caps, higher high, 80 line of the mid caps, higher high, 80 line of the small caps, basically the same high. So your weakness is mostly contained within the small caps. Not a big surprise. I showed you the Russell chart. Okay, so this gives us a little bit of a look underneath the hood and shows us where the weakness actually is. All right, so new highs here. This is new high. These are new highs at the NYSE. Okay, when the market does well, okay, and is healthy, you can see here you get just oscillations, you know, at a decent level. Not too high, not too low, just somewhere in the middle. You don't want really high prints because that would suggest some sort of blow off top. You don't really want really low prints that suggest some sort of weakness. So the fact that we're getting oscillations at this middle level is actually very good. Okay, maybe in the near term you could say, hey, it's trending down a little bit. That's fine. I mean, you get little trend downs within the range. They happen. You know, we got like one here. But until you get an extended trend down for, you know, more than a month, I'm not going to get overly concerned. I consider this indicator to be supportive, and it's not. And again, because it's neutral and it's not too high, too low, I consider it to be in good shape. This is the cumulative high low at the NYSE. So you're taking like highs minus lows, plotting it. This is more of a longer term chart, longer term indicator. You can see back here, we got a buy here and a sell here, buy back here, sell there, we got a buy here. So as long as this is trending up above its 50-day moving average, I'm going to say the trend is up overall. So near term, you could argue that, hey, you know, new highs are starting to decline. That's fine. But overall, if you back up and look at the big picture, it's in good shape here. This gives us a little bit of a buffer. This could kind of roll over here, get caught by its moving average, and go up. Okay, so trend is up, and it's got a buffer to work with. Next one, this is new highs on the weekly time frame. So we've made good progress here. We didn't get rejected. Back, you could have argued that, hey, new highs here, obviously big difference, and that led to this big drop. But now, you know, we're back. If you compare that level to this level, new highs here to new highs here, we're in good shape. Okay, we got a buffer to work with. If this thing wants to roll over a little bit, that's fine. But overall, I'd say we're in good shape. We didn't get rejected here. You know, this didn't happen, which is kind of what happened here too. That didn't happen. So the tide has turned, and you know the market's doing fine right now. Here are new highs at the Nasdaq. So we can move this over a little. Here are new highs at the Nasdaq. Like at the NYSE, we have this like neutral level here. Not too high, not too low. Strong enough to support the trend, but not high enough to suggest some sort of blow up top. So I consider this to be a supportive indicator. And I'll go through this a little bit fast. This is the high low, cumulative high low. Okay, so it's highs minus lows. You take the cumulative chart. We got to turn up over here. Late February, early March. It's been trending up above its 50. As long as that's the case, the long-term buy should remain up. And finally, the weekly new highs. Like the NYSE, we didn't get rejected like this. We got through this level here that supported the prices. Hey, if we get a little bit of pullback here and then up, that's fine. Again, this move off here is good enough to tell me that the tide has turned. The market's in decent shape. What I would look for as far as putting in a high is what happened here. When you get a negative divergence, the market makes a higher high, the indicator makes a lower high. Same thing happened over here. Okay, but that kind of a divergence takes a couple months to play out, and I just don't see it's not happening right now. It could happen over the next couple months, but it's not happening right now. Zooming in with new highs. Here we have, you can see that the new highs among large caps. Maybe they're moving down in the very near term, but overall they're strong. New highs among mid caps, moving down a little bit in the near term, but overall strong. We got like a little push up here. New highs among small caps have been a little dampened. Okay, they're not really high, not really low. They're kind of in the middle. I'd like to see higher prints here, but not a surprise that we're getting this because you saw the Russell. Okay, so that's what I'll be looking for. That's what I'm kind of looking for, but it hasn't hurt the market yet. Mid caps and large caps are doing well enough to counter the weakness in the small caps, but something to keep your eye on. Okay, got more charts here. I'll flip through fast. Okay, this is the number of, the green line is the percentage of S&P stocks at a 20-day high. So not a 52-week high, but a 20-day high. So it's a shorter term indicator. The absolute print right now, right here, is very good. This is great. Okay, what we look for to support an up to suggest to characterize an uptrend is just oscillations above and below its mean, which suggests expansion, then a little bit of, not weakness, but expansion, then a rest, expansion, then a rest, expansion, then a rest. So if we get prints up here, that's fantastic. Okay, maybe we have a divergence forming here. Okay, but what I found is divergences that form at a high level don't tend to play out very quickly or with that much urgency. It's only when you get divergences, like here's a divergence where the market was making it basically sitting at its high, and you got a very, very big and obvious divergence, and this print over here was at a very low level. Okay, so the divergence is notable. Okay, I'm not going to completely ignore it, but again, divergences that take place at a high level are a lot less powerful than a bigger divergence at a lower level. Okay, similar chart. This is with the NASDAQ and then NASDAQ 100. Same thing, a bigger and obvious divergence will lead to a bigger pullback, whereas a divergence that takes place at a higher level, this one is taking place, basically at a very healthy level, it's going to take a lot longer for this to have an effect on the market. Okay, a couple more here. Here's the percentage of stocks that are above their 20-day moving average. As you can see, we have a divergence in place, but as long as the indicator oscillates like in this box, I would consider the market to be in good shape. Okay, it's always been like this. When the percentage of stocks above their 20 is above 50%, you get oscillations, brief dips below, but as long as it's above 50%, the market does pretty well. If this kind of comes up here and gets rejected and starts moving down to the bottom of the box, I'll get a little bit more concerned. But as long as we're getting prints, middle of the box, that's actually pretty good. So I'm starting to note the divergence here, but I don't think it's urgent yet. And here is the percentage of stocks above their 50-day moving average. Okay, similar concept. As long as you get prints that oscillate, in this case above 55%, the market's in good shape. And that's what we're getting. We have a healthy print here at 70%. Divergence is in place here. I'm much more interested in if we get something like this as the market pushes higher. Okay, that's kind of what I'm looking for. If you look here, the market was like at its high, but the percentage of stocks was already at the bottom of the box, and so that was a big divergence. Okay, so even if we get a move up here, this would be a divergence at a higher level, which is much less negative. So keeping an eye on it, but it doesn't seem like it's going to play out right now. Okay, so overall the market's doing fine. Perhaps it is neutralized a little bit in the near term. The 10-day AD lines are trending a little bit lower, but the cumulative lines, which have longer term implications, are still above their 50-day moving averages and are still trending up. New highs are rotating up and down in the middle of the ranges, not too high, not too low. New highs on the weekly time frame are doing well. Zooming in, new highs on the 20-day highs are doing well, albeit possibly forming a divergence. S&P stocks above their 50-day moving averages are within a healthy range, although they might also be forming a negative divergence. So in the near term, I could argue the market has neutralized and is due for a little bit of a rest, but overall things look good. I have no reason to abandon my overall bullish bias. All right, so thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube and be alerted of new content when it's posted. Come check us out at Leavitt Brothers. If you're not getting the results you want, change something. Change the types of trades you do, change how you do your research, where you get your ideas from. Try different things until you find something that works. Check us out at Leavitt Brothers. Perhaps we can be the key ingredient that gets you over the top. Again, thanks for listening, and I'll see you next time.